In this video, we are going to talk about long-term assets, long-lived assets, or property, plant, and equipment, as they generally called. So the categories that we have is plant assets, natural resources, and intangible assets that the three we gonna talk about. Well, the plant assets are usually called property, plant, and equipment. And they are land, buildings, equipment, furniture, fixtures, automobiles, airplanes, ships, computers, electronics item, TV, and whatnot. Among all those, land is the only asset that do not get depreciated. Do not get depreciated. Okay. Intangible assets are the assets such as copyright, trademarks, patents, franchises. These are the assets that we cannot touch them. They don't physically exist, but these are basically claims that we have. So plant assets are different from other assets because plant assets are long-term. They are last several years. For example, you build a factory, they may last 30 years. You buy a truck, they may last 8 years. For example, you have a furniture, may last 10 years. So these are the cost of a plant asset is allocated to an expense over the years the asset is expected to be used. Here is what we call the matching principle. You remember in the matching principles, we have to match the cost that has incurred in order to produce the revenue that we have produced. So for example, you purchase a truck. You paid $50,000. That $50,000 is went out and you got the truck in the business. However, you cannot say that your expense is $50,000. You have to divide that expense over the life of the truck. So suppose your truck is going to last 10 years. So if you're using a straight line depreciation, your your expense for the 10 years is $5,000 every year. Okay. The allocation of plant asset cost over issue is called depreciation. It follows the matching principle we just discussed. A plant asset is recorded at a historical cost. Historical cost is the cost that you have paid to acquire the asset. So for example, you paid $50,000 to get the truck. That is the historical cost of the truck. This follows the cost principle, which states that the acquired assets and services should be recorded at their actual cost. So for example, the price tag of a truck is say $40,000. You pay $5,000 tax on it. You may paint your name and other things. It costs you another $3,000, and you add few other things in the truck, and the total truck is cost you $50,000. Even the price tag was $40,000. You add additional $10,000 on it. So that's the actual cost or historical cost of the truck. As I said further, the actual cost is the purchase price plus tax, commissions, other amounts paid to get the asset ready for its intended use, whatever the reason you want to use. The next topic we're going to discuss is the depreciation. Depreciation is a non-cash expense in which we just try to match these expense with the revenue that we have generated. So depreciation matches the expenses against revenue generated from using an asset. For example, the truck that you have purchased is a delivery truck. So what you are delivering? You are delivering some product or services. So that means this truck is there to help you. So you have to take the depreciation into the expense and include, even though you didn't write a check, but you have to include it. All assets except land, as I said above, were out as they are used. Wear out as they use. Wear out means they lose their value. Some assets become obsolete before they wear out. An asset is obsolete when a newer asset can perform the job more efficiently. So for example, you purchase a computer, and after 1 year, this computer is obsolete because another new computer is out there, which is cheaper than the previous computer and much more efficient and much more options it has provided you to do the job. The period of depreciation is the asset's useful life. So how do we know that what is the useful life of an asset? Usually it's a guess, an educated guess. You can ask somebody who has used this asset in their business. You can ask your CPA, or you can ask the company who's selling the asset to you. So for example, you're buying a truck, a Ford F-150, you can ask the Ford dealership, hey, what do you think? I'm going to use this. I'm a plumber. I'm going to use this in my plumbing business. What do you think? How long this asset is going to last? They may say it's going to last 100,000 miles. They may say it's last 150,000 miles. They say it lasts 200,000 miles. So now how many years do you think you're going to drive 200,000 miles? Maybe 5 years, maybe 4 years, maybe 7 years. So it depends. The company must also estimate the asset salvage value. What is the salvage value? When you are going to retire the value. So for example, if we are retiring the Ford F-150 truck that we have bought after 7 years, what is the value of the truck we can get if we sell the truck 7 years from? So today is a $50,000. 7 years down the road, it may be $5,000. So the $5,000 would represent the value, salvage value of the truck after its useful life, which is 7 years. The next thing we're going to talk about is accumulated depreciation. Accumulated depreciation is a cumulative depreciation. So for example, when we have an asset here and it's truck, which we got for $50,000. Okay, this pen is not working. Let me get another one. And we know that this truck is going to have a depreciation of $5,000 every year. All right. So that means every year we're going to keep a track of all this depreciation. So accumulated depreciation keeps track of the depreciation as long as this asset is on your books and you are using this particular asset. So you're going to leave this account as is until you retire, and you're going to keep accumulating the depreciation as long as you are using. So the difference between these two accounts is basically the book value of the asset. So after the first year, after the second year, you have a 10,000. So the book value after 2 years would be $40,000 for this asset. That's the reason you have to use it. We already discussed the salvage value. Depreciable base is equal to cost minus the salvage value is equal to depreciable base. So for example, in our case, it's the cost of the truck is 50,000 and salvage value is 5,000. So depreciable base is 75,000 for how many years, excuse me, how many years we're going to depreciate. Carrying book or book value, as I told you already, is the asset value at any given time minus the accumulated. So book value is carrying value. Book value is the cost minus accumulated depreciation. So after 2 years, it's 50,000 minus 10,000 is equal to $40,000 is the carrying value or the book value. Depreciable base is used to calculate the depreciation expense for per year, and carrying value or book value changes every year. Okay, depreciation methods. There are 3 depreciation methods used. That about 80% of the companies use a straight line method. Then they also use unit of production and double declining balance. For the ease of use, I mean, which is the most simple method, is straight line. But which is the perfect method to calculate exactly how much you have depreciated? So this is the best method to calculate. If somebody asks you a question, which is the best method or which is the method that captures accurate depreciation expense, is the unit of production. Double declining balance is used for assets that depreciate very fast. For example, computer products, because computer products depreciate very fast. So we use double declining method. Depreciation expense is reported into the income statement, and this accumulated depreciation is reported in the balance sheet. Always remember that accumulated depreciation is reported in the balance sheet and the depreciation expense is reported in the income statement. A straight line method. So for example, equipment costs 5,000 with a 3-year useful life as a 500 salvage value. So the depreciation would be $1,500 per year. If you wanna do a total, so the value of the equipment is not going to change, it's going to remain the same. The cost, this is the cost that we have paid. Annual depreciation expense is this. Accumulated depreciation is changing. So first year 15, second year is 33,000 and 4,500. And assets book value is changing. First year is 3,500, second year is 2,000, and a third year is only 500. Okay. This 500 is same as the salvage value. So this number and this number is always the same. The next thing we're going to talk about is the unit of production method. In the unit of production method, we use the unit. For example, I mentioned earlier whether a truck is going to last 7 years. So the Ford company might tell you that this truck is very good to go for like 200,000 units. So for example, you bought a truck $5,000. Your salvage value is 5,000, and if the truck is good for 200,000 miles, so your depreciation expense would be 45,000 divided by 200,000. So how much is going to be 45,000? So it's 45 over 200. So it's going to be about, let's calculate how many is going to be per. So it's 200 divided by 45. So it's 45 divided by 200. It's 0.225 per mile. So for example, first year you drove this truck for 15,000 miles. So the depreciation expense for 15,000 miles is going to be 15,000 multiplied by 0.225. So if you multiply this for 15,000, you have $3,375 of depreciation expense for the first year. So that basically calculates the best possible or more accurate method of depreciation. The double declining method is an accelerated method, as I said before, and its cost near the it takes it in a way that you get most of the depreciation in the first year. So for example, here is an equipment cost $5,000 with a 3-year useful life, have a 500 salvage value. One difference between double declining balance, unit of production, and a straight line it. In a straight line and unit of production, you take the salvage value right away. But in the double declining method, you do not take the salvage value upfront. Instead, you depreciate up to the salvage value. So for example, you see the accumulated cost is 5,000. There was no depreciation the first year, but when you calculate, you are calculating 66.67%, and it gives you 3,334 in the first year. Next year it gives you 1,111, and the third year you have only $55 depreciation. So the most of the depreciation you get in the first year and in the second year. Okay. Changing estimate of depreciable asset is possible. What usually happen is depreciation expense is an estimate. Depreciation expense is an estimate, and in accounting, estimate could change. For example, you bought a truck and you thought that truck is going to last for 5 years, but you realize this truck is going to last only 3 years. So you are changing after first year, for example, from 5 years to 3 years. So that's possible. Also possible. You could also change the salvage value. So, but after first year, you have to make sure you calculate a new depreciation expense starting second year based on the remaining 2 years. Changing estimation of depreciable asset, it's also the same thing. Useful life, so useful life estimate or estimated residual value, both could change. Reporting plant and property, plant and equipment reported at book value on the balance sheet. Book value again is the same thing as historical cost, or the cost that you paid minus the accumulated depreciation. However, keep in mind on the balance sheet, we present both the book value that we paid, or the cost that we paid, and the accumulated depreciation on the book. Disposable asset, disposal when we are disposing of the asset, either because they are absolute or obsolete, or because they are wear out. The business then has several options: discard the plant asset, or sell the plant asset, or exchange the plant asset for another asset. Okay. Regardless of the type of disposable, there are 4 steps. Bring the depreciation up to date, remove the old, dispose of asset and associate accumulated depreciation from the books, record the value of any cash received, and determine the amount of any gain and loss. So for example, if you bought the truck for $50,000, so your historical cost was $50,000. Your accumulated depreciation is say $15,000, and now you are discarding it and you're trying to, or you're selling it, for example, and the sales price is $25,000. So what is coming in the business? The sale, what is coming? So you're selling it, so cash is coming in, so you debit cash for $25,000. What is going out of the company? The truck, 50,000. So you're going to credit truck that came on 50,000 is going out in 50,000. You have an accumulated depreciation that also going out, so you're going to debit the accumulated depreciation for 15,000. Now over here is a total of 50,000. Here you get $40,000. So what do you have? You have a loss on the sale of the truck, which is $10,000. So this is what you have to do in order to dispose of the truck. Okay, so we are done with our long-term asset lecture, and the next lecture we're going to talk about current liabilities.